Welcome to the latest edition of the Allsop PropChat podcast. My name is Richard Adamson. I am the Managing Partner of the Residential Division at Allsop and one of the auctioneers in the residential auction team. I'm joined today with Andy Pointon and Alex Masters. Andy from our Build to Rent team and Alex Masters, who works with our L&M team. We are going to dive deeply into the world of Build to Rent. First things first, if you could both have a little intro as to explain who you are, what you've done and what your background is. Andy?
I've been here 20 years, been at Allsop 20 years, came through the graduate system, spent 10, 11 years in commercial national investment, and then was one of the founder members of the Build to Rent team when we set it up about 9 years ago. We'll come on to the difference in a minute, but initially focused on multifamily Build to Rent. More recently, probably a bit more of a swing towards single family, mainly down to market drivers.
And 9 years?
9 years, yeah.
God, time flies, isn't it?
It does. Hi, I'm Alex. I was at Granger for 16 years, so I can top that. And I've been at Allsop Lettings and Management for coming up 4 years in June. So when I was at Granger, I worked predominantly on their regulated and PRS portfolios in the North East region, which is where I live, and came into Allsop to help them manage what's been classed as one of the first single family housing portfolios that was called Thistle, then Domus, in the Northwest. And that's why I came into Allsop, and since then we've launched many more single family new build sites.
Okay, so both of you, I suppose, have come from a traditional investment background before getting into this particular sector. Okay, well, you touched on it first of all, Andy, there. I think first things first, obviously we've got a very diverse audience in terms of their exposure to resi, commercial, auctions, Build to Rent. Let's start with the basics and then we'll delve into the detail a bit more for those that are a bit more informed. Build to Rent, explain what that is and probably some of the differences to what we would deem PRS, private rented sector.
Okay, probably the first thing is institutional investor target audience, references that will be familiar to people in the sector, multifamily and single family. And think for the very basics, flats and houses. Yeah. So multifamily is dense urban locations, high-rise buildings, probably amenitized buildings. Single family is in more suburban locations. Unit numbers are between 75 to 150
But strip
units.
back even further than that, it is a sector that was set up with the primary objective of building with a view that all the units would be rented out effectively.
Yes.
Okay, so there's no break-up of buildings. It's not standing stock PD developments. It is, from the very beginning, from land buying, planning and getting it all through, has been set up for that very purpose.
Designed for rental, specifically designed for rental.
And what you're saying is there's two fundamental sectors within that, if you like, which is single family and multifamily.
I mean, the multifamily sector is, as Andy says, dense high-rise buildings where you get individuals or sharers tend to be the demographic moving into apartments, fairly transiently moving in and out, benefiting from the amenity and the professional management. And single family is your more suburban schemes. Can be some low-rise flats, but mainly houses, and obviously that leads more to a single family unit demographic.
Okay, so your multifamily, I mean, again, I know there's exceptions, but generally speaking, is your younger professionals coming out of university or coming out of education, sharers.
So when we're saying multifamily, we're not talking about loads of kids and loads of different families living in a flat. We're talking about households, basically, is where the...
And the single family is just that, it is more traditional house with a family.
Household, Okay. We do get sharers and we do get individuals, but primarily it's families that tend to take up the stock.
So that sets the scene, doesn't it, in terms of what you actually do and what that market looks like. But sort of diving a bit deeper into that, are there significant differences within those two sectors for single family and multifamily in terms of locations, in terms of your client types and developers and people that specialise in that? If so, what are they?
Yeah, so as I touched on, multifamily tends to be in city centres, so there'll be generally high-rise buildings. The developers in that space are probably commercial-minded developers, so it's probably developers that have traditionally built student accommodation, traditionally built hotels, who are interested in the kind of de-risked funding product, so are not house builders, are not set up for taking sales risk. They're more interested in the kind of package sale, might take a reduced level of profit because obviously it's de-risked because you're 100% sold. And generally the investor would look to forward fund that, so would effectively finance the development. I won't get into the nuance, the detail of the structures, but that's attractive to a certain type of developer that is not set up for sales risk like a house builder. So what you would usually get there is a developer, and then you would probably have a third-party contractor, and there would be a relationship between the developer and contractor who would deliver it turnkey for a investor. With single family, it's more house builder driven. They're very different markets, very different kind of subcontractor markets. And so it's scale house building. So you need the efficiencies of scale to build houses and to be able to deliver at the build costs that are required generally to develop for the institutional capital that's in the market.
I've got so many questions, I should be writing them down. But so when you're looking, for instance, at the single family and how that's changed, because you look at house builders for obvious reasons, you describe that very well. Have the same house builders been in since the beginning of that? And as the wider residential market's changed in terms of development, have there been more entrants that wouldn't have touched it 5 years ago that are now playing ball?
Yeah, mainly down to market forces. With multifamily, there's been a lot of well-publicised challenges on building high-rise buildings. You know, we've had the changes to Building Safety Act, Gateway 2. There's a lot more risk in developing and bringing forward high-rise development.
Cladding.
Build cost inflation, the need to have two means of fire escape. Mm-hmm. There's been lots of challenges to that sector, which we will overcome. It's just been almost a perfect storm of challenges to build high-rise buildings. On the flip side, with single family, the slows down in the sales market, the abolition of right to buy, it's all kind of put a squeeze on house builders. It was very challenging. It wasn't really scalable. We go back to kind of the Liz Truss kind of time where the market fundamentally changed. Before that, it was very difficult to get the house builders to do it at scale. They were still selling houses, so it was very difficult to get them to turn to this. It's what they've always done. It's what they know. They understand the risks of it. They're happy to delay development. You know, they've been through cycles. This slowdown has been prolonged. And so I think it's probably made more house builders look at this sector as a tangible proposition for them to keep their builders on site. What we find the fundamental difference between the two sectors at the moment is that the capital that's there to invest, single family, works for the returns for that capital, still generating profit levels for the house builders that is conducive to them to build. The challenge is that on the flip side with multifamily, there's just been more challenges to overcome. You know, we will, as we've now seen the challenges around Gateway, which is basically a approval process you have to go through at stage 4 design of a building. When that came to the fore, the target was a 12-week turnaround on Gateway 2, and it was really 9 months a year because, you know, probably resource and, you know, challenges of actually going through the process really slowed down the market. So yes, there's been viability challenges in multifamily, but it's wider legislative challenges that have probably compounded it to the degree that it's really slowed it down. Whereas in single family, lower rise, not tall buildings, house builders are just used to going through the risk of going through planning themselves. And so we are picking up sites off the house builders at a much more progressed stage. Whereas in multifamily, it's more bespoke design. It's probably an earlier integration with investors. And so single family has just been more suited to the challenges in the environment that we've been operating in.
On that point with investors, who are the investors here and who ultimately... Because there's a few pieces here that, you know, your role, you'll start from the very beginning of buying a site on behalf of investors and piecing it all together till completion. And then when it's completed and you've got the lettings all out, which is where you come in, Alex, like, in a nutshell, how long can that take for you to get involved from day one to the exit on these things?
Multifamily, multiple years, because we'll probably get involved at land acquisition stage. So we're very fortunate as a business at Allsop to have all the kind of pieces of advisory that you need to take it from concept to reality. So we would assist on the underwrite of that initial land acquisition, Then we support the developer through the stages of design, working alongside our management team that manage over how many units now?
I think we've got just over 2,000 single-family units under management with a pipeline of 5,000 in build.
Every single multifamily development is different. It's architect design led every time. So there is a lot of consultant involvement in bringing a scheme forward that is right for that market and we can make viable. So having the guys at Lettings and Management here, we can continuously keep an eye on that operational side of the appraisal, because the more efficient that building is to run, the more value will be created.
And by more efficient, you mean that includes the rents and what people are paying? Because that must have a huge impact on...
Yeah, I mean, that's the element that me and Andy sometimes fall out over is rental levels in an underwrite, but in terms of expenses as well, it's pretty key. Like, how can you operate? Well, a building in multifamily we've probably got a lot more data on that now, but in the single family market, it's still quite new. So, like I say, we've launched 25 or so schemes in the last 2.5 years. And that's the speed of growth, and how do you operate that when the locations are so spread out across the country?
And how do you do that? And proportionally, what's the difference between, I mean, forgive me for being traditional resi, but the gross to net.
I love gross to net. Yeah, that's my history. So I would say on a single family scheme, you would be disappointed to run it at anything over 20%. I think a good, well managed and ideally well built scheme by the builder, you should be aiming and be happy with 17-18%, inclusive of a management fee to a professional manager.
Right, okay, so that is rent collection, that is dealing with day-to-day issues within a building as they come up. Okay.
I think it can be ever so slightly misleading on the percentage, because people get a little bit too tied up on percentage. It's how much is that going to cost to run per unit on that site.
Right.
Because if you're looking, and generally there will be regional variances in terms of salaries, in terms of council tax levels and things like that, but generally would cost similar amounts to manage. And in one location, you might have rents that are at £18 a foot, and you might have another location that are at £26 a foot. So one could be operating at 19%, the other at 16%.
Right.
But
Just
they're fundamentally
based
the
on the
same
rents,
scheme in different locations. Just because the rents are higher, then obviously the percentage is going to look different.
Yeah, a lot of our clients are now looking at that. Definitely the cost per unit at exit or year 5.
And who owns these blocks? Who ultimately, I know they're complex, and by all means go into that dirty detail as to that.
So just
who owns it? You're gone.
Just coming back to your kind of question on how long we're in it for. Obviously, multifamily, very long drawn out. The advantages of single family, I kind of go back to what I was saying, is the house builders are used to bringing them further down the track. Mm-hmm. What we tended to find in the early days with the house builders was we tend to be a discount to sales pricing. It's not run off a discount to sales. You know, it's run off an investment price, and then we will look as a check and measure, how does that sit against private sale pricing?
And how does it? That's
10 to 15% generally, up or down a bit. We've seen it skinnier than that when we're back in the bull market.
And that's individual granular values, if you like, for individual units in the open market rather than investment values in the wider sector.
Yeah, so what we'll do, if we're given a site by a house builder, we'll say, can you give us your sales pricing? Just so we've got that as a yardstick. So when we're doing the investment calculation, we can see how attractive is this going to be to the builder, because we know what their aspirations are on a sales price. We will always go and check those and do our own review on what sales pricing is, but it's good just for us to know, do we think this has got a chance of working? Because we know generally what the discounts that are acceptable to the house builders are.
And on that point, forgive the question if it's naive, but why would a developer that, for instance, because I go through this in the auction world, discounting from those numbers, you'll know that from your Ranger days and the regs, but when you look at that, what is appealing to a developer that run on, fine margins, that says, okay, for numbers' sake, a 10% discount from the open market value is appealing to me because...
It's de-risked, 100% de-risked. So you're effectively buying them day one. So you're not got any sales risk.
And no fluctuations in the market risk.
No. You are agreeing that price today.
Which is extraordinary in a turbulent market, right?
Yeah, so the way that the transactions are structured is that the fund will require the developer to fix their price on the development. So
and the contractor on the build.
Yes, so the house builder will generally develop a contractor in single family. The real challenges we faced in the early stages of single family with the product that the house builders were bringing to them, they weren't fit for purpose for rental. Yeah. What I mean there is you will find that there will be an optimum unit size to generate the highest rent per square foot within a unit. For example, if I've got an 85 square metre 3-bed, which is efficiently sized, so long as all the bedrooms, and Alex is very hot on this, that it is a 3-bedroom house.
Yeah, not 2.5.
And I'm getting £20 a foot off that rent. If you add another 5 square metres on, that's probably coming down to £19.50 a foot. Right. Because the rents don't tend to go with the unit size.
There's a cap, isn't there?
Yeah,
so what we were getting a lot of was big 4 and 5 bed houses to start with, which tend to not work for my residents.
They do rent, but they rent slower. There's obviously a much smaller demographic that needs that space, but also can afford that space. So, yeah.
So on that rental point, I suppose I'm just trying to sort of apply some logic to this. I suppose the single family, the rents in that sector will be broadly the same as the private rented sector for Mrs. Miggins, who's renting her house down the road, a similar size.
So, yeah, I did a piece on this a couple of years ago. So, from our experience so far, I did put a finger in the air at the time to say, I would say about a 15% figure on top of your local PRS.
And that's because you've got your new build premium.
You've got your professional, brilliant management company. You've got nearly all of our schemes include broadband, which is a bit of a It's been over for multifamily, but it's day one internet. It's no contract. It's nice and easy for moving. Yeah. We've bought in new tech on a lot of the sites, which is obviously investor led,
such as
smart locks. So Bluetooth access on your phone to your front door, sharing keys, not having to carry a manual key around. Some smart thermostat technology. We've got some leak detection in some of them.
So in principle, it's a better place,
it's a better
product to live. And also, I guess you're suggesting there by some of that tech that your bills are less.
Security of tenure. I mean, obviously with the Renters Reform Act, that's slightly changing the picture. But a couple of years ago, it was also the security of tenure. These houses have been built for rent.
And never
I've had to move 3 times because my landlords wanted to re-rent or put the rent up or sell, and I've had to move.
Well, so the tenants have a longer tenancy period, or the houses are restricted?
Well, we offered longer leases at the time. Now, obviously, that's becoming null and void. But because we could sell it as a build-to-rent product, we could sell that security of tenure, as in this house is for rent. Yeah. As long as you conduct yourself as a tenant, there's no reason for us to move you on.
And then from the tech point of view on some of those as well, is that the sell also that it's greener and in theory lower bills for people once they're occupying as a consequence of that.
We've got a variety of clients and some of them have gone higher on spec than others. So the package living schemes that we operate at the minute, backed by Aviva, they've gone in pretty hard on spec, and from day one it's been a ESG requirement, no gas. So all of them are air source heat pump technology, a lot of solar PV, and we're now doing Octopus zero bills for tenants, which means it's obviously another massive benefit. So they don't have an electrical bill to think about every month.
And I suppose, is that any different? Are there main differences then with multifamily? Because I'm guessing that you've got higher costs there running the communal parts of a building.
Yeah, exactly. A lot of the BSA stuff, but that was already there. You know, you always had to service communal areas, keep them safe and clean, have an on-site presence and a face at the door and a concierge. And so, the costs of managing multifamily are significantly
But do the multifamilies, or some of them, have facilities there, gyms and all that kind of stuff? Whereby that's part
You've got to operate them, yes. And you can amenitize and you can charge for certain items to try and make a return. But, ultimately, the underlying costs are a lot higher. I would say, again, I prefer percentages, but appreciate they're not always inaccurate. But if you're running a multifamily scheme for less than 28%, then I think you're doing a good job.
But in essence and in short, it's a better quality product for the tenant, and it's a lifestyle choice.
It's a lifestyle choice, We're encouraging people to move in and stay with us, and we're starting to try and build brands where even if we've got someone that has to move for a job, they do actually ask us, have you got a scheme in Ipswich? Or I'm going up north, have you got a scheme? We have had people move between schemes now, which is good.
With single family, I suppose it's aiming for kind of community creation, isn't it? I know you do actively encourage
We do a lot of resident events.
residents events.
In the multifamily or single family?
And single. So I think the benefit of Allsop is obviously we managed a number of multifamily schemes before we really got into the single family housing arena, and we've taken a lot of the innovation learnings from the tech, but also keeping residents engaged. We're very big on home views because they're verified resident reviews. So rather than Googling a scheme, home views is verified. They have to be a tenant there. They check that. And that gives us a real feeling of how engaged our residents are and how happy they are. Yeah, we just won Single Family Housing Operator of the Year for the third time in a row.
Wow.
From inauguration. So we're pretty pleased with that.
Yeah, as you should be. Congratulations. There's so much here, and I'm trying to make it as structured as possible. We touched on it right at the beginning, and I probably interrupted you at some point there about location, and you broadly gave us an idea of, I think, the multifamily, city centre, town centre, those sort of places for obvious reasons. Obvious question, how does the locations differ? What's a good location for a site, and what are people that you're dealing with your clients now looking for now in terms of sites and locations, and what ticks the boxes?
So for single family specifically, as Alex touched on, we're talking about a different demographic. We're talking about families.
Mm-hmm.
They're looking at employment, proximity to employment centres. They're looking at schools, school supplies. They're looking at, proximity to doctors' surgeries and, all the things that families would want, and pubs,
cafes.
What we want to try and avoid is new developments which are detached from conurbations. What we really like to see is urban extension from towns. So either infill sites in well-established kind of communities that are already there, or it is that extension out from the town where you've got close proximity into the centre.
Okay, so what's the density are you looking for? How many is this? What's the smallest amount of units a site would need to take up to the maximum for single family at the moment that you're looking at?
There's probably two ways to look at it. Alex will probably tell you on kind of optimum in terms of kind of absorption. I look at it kind of on scale as well. Most of the strongest capital. There is some that would go below and above, but generally 75 to 150 units I would say is the sweet spot for single family. We try to, because this is institutional capital that want to invest, a notable amount in any given location. So I'd say we'd be trying to target a £20 million lot size.
Yeah, I think from a management and operating expense point of view, obviously the higher the number, the better and more efficient you're going to be able to manage it. If you could draw a massive circle around London, that is where the majority of our schemes are at the minute.
The single, multi?
Single.
Yeah.
Hoping to get a few more nearer home in the north at some point. But obviously, due to market conditions and the ability for investors to be able to buy that many new build houses at that discount in the south, they're obviously making that work.
It's been a bit of a yo-yo, really. If you look back in the day, and you mentioned Project Thistle, which was probably the first single family scale portfolio that we understand it and see it today, that was Northwest.
Yeah, that
generally
was
Northwest
Manchester,
focused.
Liverpool, 900 units across 15 sites. Yeah.
I think what investors in the market have been able to do is cherry pick a little over the last couple of years, just because of the slowdown and the interest of the house builders. So of course they're going to go to the locations they couldn't usually get, and that's South East Midlands, those kind of locations, the nicer areas of the southwest. But what we're starting to see now is some of those core investors that have come in and done that, understand the market, understand the product better, and now going into the other locations and regions. And it is really quite amazing to see how the larger scale national house builders can make it work in those tighter locations.
Yeah.
What are you looking for? What locations? What sizes?
Generally, we'd like to see over £300 a foot in terms of a sales price. Because that, if you think about it, creating a land value, build costs, profit, we tend to like to see over 300. But I have been pleasantly surprised in some northern locations recently where we've come out 250, 260 a square foot on investment price, and it's still stacking. So what you will tend to find in those locations, though, is probably a tighter discount to sales pricing, because it has to be a certain level to be able to build it. So if a location is 350 a foot and you price it at 300 a foot, it can probably still be built, and it's probably a developer decision on the margin they take. Whereas if it's a 260, 270 a foot sales market and you're at 240, they might not be able to build it for 240. So you tend to find it's probably squeezed up to probably a 10% discount to sales in those more margin locations. But like I say, that's not the main driver. The main driver is investment pricing. Is it hitting target returns over a period of the investor hold period? And
is there a rental demand in that region?
And
transport links are massive as well.
Looking at, we've done some research recently, and it's very interesting to look at some of the more marginal locations where it is harder to build. There's been a major squeeze on supply. We've seen the biggest slowdown in supply in the northeast and Wales, and we've seen the biggest contraction in time to let, how long a property is on the market in those two locations. That says to us that's where there's the biggest demand.
Right,
it's huge demand. Yeah, I think when we were managing that Domus portfolio, it was that peak lettings period where Rightmove were reporting that 50 people were applying for any one letting within 2 hours. It's not quite as hot as it was then, but yeah, in those regional locations, there's just a lack of quality homes to rent. So it's all old POS stock or landlord with 10 houses that are 100 years old and drafty. And
so in terms of, and forgive me for zigzagging, so many questions keep popping into my head as you explain all this. From a rental perspective, forget renters reform for a moment, we can touch on that in a minute, but typically speaking, what were the range of tenancy agreements that were taken in terms of terms?
And we tried to make a thing of offering longer term tenancies. Interestingly enough, the majority of applicants just wanted a 12-month term and were happy with the 12-month term. So I would say anything more than 12 months was in the very low single percentage marks.
And that's the same for both single and multi?
That's just single. Multi, I don't know, if I'm being honest. I think it's a very small percentage of the demographic who are maybe very more security conscious or have had a bad lettings experience that were asking for those longer tenancies. And they had built-in rent reviews, so as it's a build-to-rent product, they know it's going to be for rent. So they don't particularly need that longer-term guarantee. And if it's got rent review provisions within the lease anyway, each year, then just sign a new lease each year, have the flexibility to end that lease.
In your world, let's still shake it down a little bit, but the renters reform, how's that playing out?
It's going to be interesting. So not long to go now, is it? 1st of May. So we've obviously, as a business, we've done a lot of work on preparing for the statutory changes and making sure our systems are able to cope with good old-fashioned Section 13 rent reviews instead of renewals. I think the two biggest concerns for investors and landlords is rent challenges with the FTT, and the other one is obviously the ability for a resident to be able to serve 2 months' notice at any time from the 1st of May, regardless of how soon they moved in or how long they've been there. I would say single family is probably more robust than multifamily because
I think so, because it's families and, I don't think they particularly want to move.
So, from a personal experience, we had to move 3 times in 4 years with 2 older children, and because our landlords were selling until we bought a house, and it is an absolute chew moving a house.
I think the recent announcements that there will need to be a payment for a challenge,
yes, the FTT.
And it's not a significant one, and so if there is a true grievance from the resident, it's not going to obstruct them doing it.
Yeah, and I suppose with that, I am generalising. I think that's important given the volume of stuff you deal with, but single families are more likely to be anchored with jobs and schools and friends and what have you, and support as well.
Yes.
I suppose in theory, so that makes a lot of sense. Okay. One area we haven't gone into yet, and I think now we sort of set the scene and gone into some of that sort of high-level detail. Who's in that market? Who ultimately ends up owning these? And has that changed over your 9 years doing it all in terms of who's actually owning these buildings? How long are they holding them for? What's their exit plan? Is there one? Are there buildings like this trading that were built 5-6 years ago?
If we're keeping it specifically to single family, there probably isn't enough time for us to actually review those strategies. We had Gatehouse, who were the original owner of Thistle, who sold that on to PGIM, so that's traded a couple of times. You've seen a couple of trades from Gatehouse again, actually, to Lloyd's, a bit of Sigma selling. So some of the earlier movers in the sector have probably churned a bit, but they're still in the market to buy as well. So it's probably just individual strategy on individual.
Some fund requirements.
Yeah, there's some kind of capital partners that probably look to go from the sector that are behind some of these operators. But it's hard to see long-term trends at the moment just because single family hasn't really been scalable for that long. With just touching on I know we're talking about single family, but with multifamily, what you're seeing a lot of at the moment is just the first generation of build to rent multifamily being traded. When I say first generation, there's been changes and evolutions in multifamily, but the true wedge which was put in when there was a requirement for a second means of escape, you think it's a lot of core institutional buyers in that sector. They want latest kind of regulation type product.
I feel like there's quite a lot of activity going on trading, and do you think that's being driven by the fact that people are struggling to build?
When you say a lot by build to rent standards, not a lot by any other sector standards. There's been more trading. You're probably coming to end of strategy in some circumstances. Probably a recycle of first gen wanting to invest in second gen if they can and fund. But yeah, the challenge of actually building at the moment has probably pushed more people towards.
Those trades happen. I mean, again, is it because you have the building, as an investor? Wouldn't you get private investors that will say, actually, I'll take that because the management comes with it. I can sit there. I know what my net is effectively. I know you've got better phraseology than that, but I'm going to sit on this for a number of years and it is just going to feed me. Or is it just institutions and property companies that are going to buy it?
I think you've got two levels of institutional investor. What we're seeing now is probably some movement of more value add core plus investors in the market, where it was always probably more core capital because the returns that are on offer from forward funding were probably low. Like any sector, you will have different grades of product in the market. And what we've probably seen on a few of the trades is maybe operator hasn't managed it amazingly well. There's probably some voids in there. There's probably some latent rental growth in there. And some of the higher return targeted capital that's coming in that's probably a little bit more hands-on than some of the other investors in the space have seen an opportunity to come in and reposition and probably sell back to the funds at some point once they've actually improved it again.
Are there new entrants now, given where we are in the market and what's going on in the world? Are you seeing some, in the past 12 months, let's say, and particularly in the past 6-8 weeks, are there new entrants that want to invest in this sector that weren't interested in it a while ago?
I think single family, I think single family has been proven to be counter-cyclical. Yeah. It has carried on. It's had its challenges. It has its bumps in the road. The last 2 weeks, for example, has been incredibly erratic, just in cost of capital, debt markets, hedging costs. But it buffers around. It's still working. It's a negotiation between investor and developer. It's still a viable product.
So for the listeners, it isn't a closed market, but it isn't just the same old people doing the same old things.
I think
more coming into it in terms of investors and also in terms of developers and contractors. Changing.
I think realistically, you've got to appreciate who the investors are. It is very core institutional pension fund capital, and so they will only really transact on a development with a significant counterparty. That's the reality of the situation. They're not developers. They don't want to step in. They're lower risk, lower return investors. They want you to develop it and finish it. So that's why there's obviously a significant preference to the bigger balance sheet PLC house builders at the moment. Will the house builders, if there is improvements in the sales market, are they still going to be there at this scale? Probably not. Are they still going to be there to transact on single family? Probably, because they've done it. And what they'll probably do is look at maybe slightly larger sites, might factor in some single family into the initial strategy. We have looked at trying to crack the nut with SME developers. Challenging to do forward fundings, just to the requirements of the fund on the developer. Forward purchase, which is slightly different. So the difference between a forward fund and a forward purchase, I'm talking about development because we are still very much in a development stage of single family. There has been some trades of single family, but not that many. So we're still really talking about development. Forward funding is where the fund would buy the site. You would enter into a development funding agreement with the developer on a fixed price development contract, fixed monthly drawdown financing of the development, probably profit towards the end of the development. So effectively the fund would fund the whole development. But the difference with forward purchase is they would pay a deposit and then they would pay for each individual unit as they're handed over.
Oh, right.
So the developer would have to go and probably get some development finance. There is more of an opportunity for an SME in that space. If they can make it work, there's less stringent requirements. Slightly less. There is still some stringent requirements, but probably more of a chance of actually being able to do it with an SME.
It'd be positive to see it because of the schemes that we've launched. Interestingly, Urban and Civic, obviously quite a big entity in themselves, have decided to do single family themselves. So they had a couple of schemes in near Rugby and Auchenbury where they sold parcels of land to Goldman Sachs, and then Savills Investment Management took it on, that we still manage, and they witnessed and saw the reports and the lease up. They've now decided to do it themselves within the last 12 months. So we launched Penny Green in Wintringham in June last year, and it's gone really well, and it is a Lodge Parker, a SME builder, and the quality on handover, the reliability of handover times has been vastly different to some of the larger house builders that we've taken properties from.
From what I understand and what I see in my role is that you have quite a unique offering, and a very unique offering in terms of the skill sets we have under one umbrella to deal with, well, you're going to describe better than me, but from site to planning to going through the whole thing and to delivery and management and then trading if needs be. Can you talk me through how close you guys work together from the Allsop LLP side, your side, Andy, and from Allsop Letting and Management, your side, from all of those parts, even though it might not be when you're actually getting paid?
Yeah, I mean, it's very much client driven and client specific, isn't it? But we've certainly got a couple of clients that are very much want us involved as soon as possible, even from a lettings and management side, to help with specification, help build operating budgets and expense forecasting.
So, sorry to go, that more, you mean obviously your experience in delivering these buildings, what people want, what people like, what tenants like, what they don't like, to get you in early.
How many units should we build?
So you can do viability. This is a good site. It will be this sort of pricing. They'll want this, and you'll get involved in design and all that.
And we can probably let 8 to 10 a month, so don't take handovers of 15 and 20 in a month because it's too many and they'll sit vacant, and it'll look like there's loads to let instead of having a really... I mean, the ideal handover phasing plan that I've been telling clients and Andy's team is anywhere between 5 and 10 houses a month is ideal.
And this is, sorry, for terminology here, this is effectively avoiding flooding the market, right?
Yeah,
and driving prices down.
Yeah, exactly. And you can create real momentum there. You can start to build the community with less people, and then as more people come, they sell that community word of mouth. You start driving demand to some areas that have never really seen a rental market. So,
which is different to how developers traditionally would have done the private. You know, it's a big launch day, reserve them all, and get it all out quickly and get the reservation fees. So it is a measured approach for good reason.
Yeah.
I think we've got a few clients that are clients of both investment and management, and they maximise to the
leverage us
hugely benefit from that, because we can give them every single element of what that investment is going to look like,
which others can't, right?
Which there is other firms out there with management capabilities. I'd say the benefit of Allsop is we're big enough to have a big presence, but we're small enough to be very joined up.
Yeah.
And we talk to Alex or his colleague Simon or Sophie almost daily. So when we're underwriting a single family scheme, there was several key components to that underwrite. Obviously rent. What do we think we're going to get on the rents? Does the unit sizes, are they right? Is the overall scheme the right proposition? We've got a research team that's been looking at these locations for a long time now, and we have a lot of data products that helps us underwrite all the demographic profiling of those locations, down to what are the average incomes for people already in PRS in that market. So we can get right into the detail to say, these are the people you're going to be letting to.
But sorry, I suppose importantly, but this is, you're doing it not on opinion, you're doing it on facts. We've got data, we've got
experience.
Got a lot of managed data now as well.
In a turbulent market for all of us, which it has been for 5 years, let's face it, that must be like gold dust for some of these operators.
Yeah, with these guys cold-face managing, we're talking to people doing it. It's not theory, it's actually on the ground doing it.
Yeah.
And, I'll ring Alex with a unit layout that I'm not quite sure about. For example, townhouses a bit challenging sometimes, but house builders like them because they're tall and you can get more on site.
Yeah.
So
families don't, because
you've got
it's just very tight on the ground floor. There's no space for the kids to run around. It's very.
But certain little nuances to site, we've got comfortable with some because Alex has spotted things when I've talked through it with him on the phone.
And fixing problems like that when you've got a huge scale development makes an enormous difference.
Huge difference. Right? We're making sure we're putting the right rents on it.
We've learned a lot. And just from saying that, the first scheme we launched, Rugby Pioneers, was, I think it would have been build to sell. It was a level build. And when we first walked into the benchmark, we hadn't been early enough involved in the specification. Walked into the main bathroom of a 3-bed house. There's no shower over the bath. Now, for sale, they'll just be expecting someone to come in and probably redo the bathroom anyway to a style that they like. But for a rental market, no one wants their teenager trampling through their bedroom to get a shower in the ensuite. So
it's interesting, isn't it? It's all that little detail which is second nature
lived
to you,
in detail,
but it's an easy mistake for those that don't know to make, I guess. Yeah. So you have conversations very early on.
As early as, we don't always, it's client-led, but the earlier the better.
If we're seriously looking at something, we'll do the scour the market on rents. We're fortunate now that in a lot of locations there is other single-family schemes there as well. So we can look at the local market rental and also look at other single-family operators. And different single-family operators are offering different product as well now. You'll get some that are looking at probably the slightly lower end, affordable end of the market, and some at the upper end. So we'll do that as an investment team. We draw upon our research team to really underpin those demographics. And we talk to management if there's any scheme-specific things that we need to think about. We'll have a look at specifications, anything missing, what are the key things that we really need to be considering here. And then finally, the golden ticket for us is getting the OPEX budget out of them, because we're not just guesstimating, we're not just assuming, we're not just thinking, well, that was that and might be that. There's so much nuance to these budgets.
Especially with the new tech and the air source heat pumps, you're talking double the cost of a gas safety check because it takes twice as long to service it.
If that budget's £500 a unit out, that has a big effect on the top line of value. So for us to be able to actually have that from them that's done bespoke for that scheme and not just us taking an amalgamated, well, that's the market view, is that as one as bids, is actually we've gone in, we know we can do it for this, and that's real value for our clients.
In terms of where you see, we talked about it on the way down here, and I know, given the timings and whatnot, past few weeks for the world's been quite strange, isn't it, in terms of what's been going on with the US and Iran and Israel and what have you. Have you seen in your specific sector anything different to how it's impacting the wider sector in terms of sentiment and behaviours and what's going on? How do you see that playing out?
I wouldn't say sentiment has changed because, like I mentioned earlier, we keep hitting bumps in the road. It's a pricing thing rather than a sector thing. Obviously, everyone who is going to try and get finance or debt or something at the moment is going to be affected. Things have changed in the market. So we are bumping around like where pricing is at the moment. I wouldn't say it's moving significantly, but it's very sensitive. Things are changing daily at the moment, and investors are having to look at that daily. And so we're just having to be, fortunately now we've developed some good relationships between developers and investors, and there's an element of trust there. And so they understand that there is challenges. It's probably just slowed down movement whilst calibration of the market is understood a little bit more.
And that also, again, it's logic to suggest that will depend on where each scheme is in the cycle. If you're going through planning and it's a 3, 4, 5 year delivery, does it matter too much? If you're going through the point of financing at the moment, it's a problem with the interest rates. If you're about to put a spade in the ground and build costs are creeping, that is it that?
Not really, because they need to really make the decisions on today to a degree. We've all thought the market's going to get better every year in the last 3 or 4 years, and we keep bumbling along the same level. So I think that kind of assumption that everything's going to get better, even though we believe it will, has subsided a bit, and we have to look at today, and we have to underwrite this today. Obviously, we'll look at, our research team are brilliant at establishing where we think rental growth projections are in certain micro locations, because there's different characteristics and factors that contribute to that. But that investor has to make that decision today in this market, and so it is a very real impact.
Okay, well, on that point, in terms of investors, then they're probably making decisions on the day, but with a bit of crystal ball gazing, right? Where do you see the next, let's just go to the end of this calendar year, how do you see the market playing out for you in terms of sentiment, pricing? What do you see and what are you hearing?
It will be a pricing thing. I don't think we're going to see significantly shifts in pricing. We're going to see slight manoeuvres in pricing. And so long as the developer side appreciates that and we're not kind of breaking into levels that are unacceptable, I can see similar volumes continuing this year. I think that even though there is challenges for investors in terms of returns, the window's probably going to be open a little bit longer in terms of just the house builder ability in the private for sale market. I have not seen a shift in sentiment in terms of wanting to buy. nobody can think that there isn't going to be a little impact on pricing at the moment with all the instability that's been going on.
Mm-hmm.
Hopefully, all we can say is hopefully it's going to settle down. I think generally we're in quite an extraordinary time where we're waiting for a tweet that could affect the whole market. Like it's
it affects the rental market. I do think it affects the rental market as well, because we had that peak in lettings, and the demand is still there, and it's underlying, and it will be there ultimately. A lot of people can't afford to buy a home now, and a lot of people choose to rent now because, well, maybe they've rented in multifamily and now they're starting their own family, and they've got used to ringing someone to get things fixed and not having to do it themselves, and they've got used to maybe moving for jobs and not being tied down to a mortgage and a chain.
And penetration in the market is single family is still a minute percentage of the overall PRS rental market. So there is a long way to go for that to become a mature sector.
Rental demand's been pretty high the first quarter of this year compared to normal. Normally the start of the year can be slow, but it's been very good across nearly all our schemes, and I think there's a bit of that related to existing landlords exiting the market with the Renters' Right Act coming in. But the demand is there. I think people are taking a bit more time to sign the lease and choose a property because of affordability concerns.
I found that really helpful, really insightful and interesting, and hopefully I'm sure a lot of our listeners have as well. As always, at Allsop, we're always interested to hear your feedback. If I haven't asked the right questions and you've got more questions or any observations, do email us. It's richard.adamson@allsop.co.uk, and I can pass it on to these guys as well if appropriate. So thank you for your time, gents. It's really been interesting, and we look forward to speaking to you guys sometime soon in the future. Thank you.
Thanks, Rich.